Okay, good afternoon, class. I hope you're having a good day. I certainly am. It's beautiful weather today, so great to be on campus here in Claremore. So I love this campus. So any rate, a little advertisement right at the first here for RSU Claremore. So no place I'd rather be, I guess. We're about at midterm, you know. I think this is the 8th week, and there's 16 weeks in a semester if you count final exam week. So if I'm doing my math correctly, we're at midterm. So fall break, I think it's next week. Isn't that right? Or do we know? Does anyone know? I may have misspoken. I meant to check the calendar myself. It's in the syllabus, I know, but at any rate, I'll try to, if I leave any false impression on that, I'll try to leave an announcement to the class. You know, maybe we meet next week and then fall breaks after. I'm not sure, but I think it's next week. Okay, you would think I would know that. But I love my job so much I don't want to take a break. Isn't that something? So don't count the days off till a day off. But at any rate, so last time we had looked at the appendix to chapter 7, and we were looking kind of conceptually how economists look at the utility maximizing problem. We had a principle there called the utility maximizing rule, or rational spending rule, that we made use of there to govern a consumer's behavior when they purchase varying amounts of differing goods. So we're going to leave consumer behavior behind today, and we're going to go on to production theory. So we're going to look at the other side of the market here. And you know, this is, as being a microecon class, this is kind of nuts and bolts class, okay? And in a macro class, you would talk more about the things that are up for debate in economics, you know, the different schools of thought and so forth. You know, you may talk about even modern monetary theory, which is very controversial, but it's something that gets a lot of space in a macroecon class, as well as Keynesian economics and classical economics and the neoclassical synthesis and all that. You may look at that in your macro class. Now in micro, there's not a whole lot up for debate here. Certainly at the level here we're looking at things in microecon, there's just really not a whole lot up for debate. This is to some extent kind of like a math course in some areas. So we're looking at a way of breaking problems down and so forth, but it's a nuts and bolts, or kind of a toolbox class in my mind, to train us how to solve or break down problems that you are likely to encounter somewhere in the production side of our economy. So if you go to work as a managerial accountant or as a production superintendent or what have you, you're going to be looking at the questions that not only have we looked at to this point, even with utility theory, you may put yourself in the shoes of a consumer, but today, and we have a little bit in the past, but we'll return to the point of putting ourselves in the shoes of a producer. And so these are tried and true approaches. These approaches here are kind of ironclad, and they're just we're embarking on a very systematic way of looking at problems that are frequent in the production side of the economy. So we're a producer. We're going to look at being a producer today, maybe a manufacturer. That's a way to start. And a typical question in manufacturing theory would be, okay, at what level of output should we bring to market or produce to maximize profit? So here, the objective will be to maximize profit. That's what you're presumably out to do in a capitalistic society or economy anyway, is to maximize profit. Whereas before, last chapter, it was to maximize utility. So here we're going to maximize profit. And so to that end, you have to think about what is profit. Profit is kind of a residual. It's what's left over from revenue after you take care of all of your costs. In accounting, we look at different kinds of costs. We won't so much in here but we talk about product cost versus expenses and so forth. Some costs go on the income statement, other costs go on the balance sheet and so forth. But today, as far as looking at things economically, we're just going to say that cost or cost, whatever you have to sacrifice a resource for, or something, it always involves a sacrifice. And once you consider the totality of all the costs associated with the particular activity, you subtract that from the revenue that activity may bring into your business, you have some level of profit or income left. So that's where we're going today. So let's start here then in chapter 9, talk about cost. If we'll go to the PowerPoint here, Radar, if we can go to the PowerPoint, we'll classify cost here as different types. Okay, so there's economic cost. Okay, economic costs are the payments that must be made to obtain and retain the services of a resource. So some of this stuff is just kind of borrowed from your text, but your text has a very orderly treatment on the topic of profit and so forth. So business decisions that are geared toward maximizing profit. So you have to know first off what a cost is. So it says it's a payment, must be made to obtain and retain the services of a resource. Now, you got to be a little careful here because there are times when you may not see the payment occur or may not appreciate when it occurs, because there are explicit costs where the payment's easy to see. So, you know, if you run a little business that has a delivery truck, and you have to purchase gasoline, you have a card that you put that a purchase of gasoline on or what have you, that's an explicit cost. It involves a monetary outlay. But there are also implicit costs. These are things that we overlook from time to time or don't fully appreciate. This involves that opportunity cost that we've looked at before, the opportunity cost, certainly of using self-owned resources. So we have talked about this before. We're revisiting a topic here in that economists have a broader view of what profit is and what costs are. And if you use your own, say, your own car in your business, then an economist would say, hey, you need to include that as a cost, that sacrifice of using your car as a cost in your business, because you know, if you weren't using your automobile in your business, you presumably, I guess, could lease it out to someone else or what have you. Or at least you wouldn't be stacking miles on your car, you know, which will hasten the day in which you have to replace it. So these things like using your own car, using a room in your own house, and so forth, all these self-owned resources are things that you may, you know, in an accounting sense, and for sometimes calculating accounting profit, we tend to overlook or disregard. But we will not in this class, okay? We'll be challenged to look at all the implicit costs, including opportunity cost of self-owned resources. Now remember, opportunity cost is the value of the next best alternative. So if you're not driving your car in your business, then presumably to something else you could be at least saving that car for, okay? Stacking those miles on your car for a vacation or something like that. Or like I say, renting your car out. So opportunity cost is very important. We'll be challenged to look at that. Other sacrifices we're going to look at. Implicit cost will involve a whole panoply of sacrifices you might not even think about. For instance, if you quit your job I used this before, but I'll use it again. If you quit your $50,000 a year job at the post office to start a new business, then you got to realize you're giving up that income you were earning from your job. So that would be another sacrifice. That would be a cost, a very real cost. All costs that we will look at in calculating what's called economic profit will have to include eventually something called a normal profit. I'll just say right here, what is a normal profit? A normal profit is, in my example I just mentioned, the person who gives up their $50,000 a year job at the post office to start a new business, a grocery store or something. That $50,000 a year income that they give up was you might think of it as their normal profit, okay? That's what they were earning. Is actually, your book mentions here that normal profit on page 175. This isn't always exactly right, but it says that a normal profit is the typical or normal amount of accounting profit that you would likely have earned in other ventures. So the idea is with normal profit is to think of kind of the accounting profit you would have earned in your next best venture. So if you give up your job somewhere, now if you use your car in your job, getting back and forth to work, you're also going to use your job in this new business. That complicates things just a little bit. But let me just say that if you're giving up a big salary to start your own business, that big salary you're giving up is the lion's share of what we call normal profit. It's the minimum return a business owner would have to stay in operation. So, you've made a bad move if at the end of the day you don't, quote, clear as much from your new enterprise as you were from your old job that you had at the post office. So that normal profit, if $50,000 a year minus perhaps some implicit costs that were entailed in earning that salary, maybe just the gas in your vehicle, that would be what you're giving up. And, if you're a smart person, that in your new enterprise, you're going to clear more than you did before you go into this new adventure. So again, it's kind of what you're giving up to go into this new venture. So that's kind of the idea we're going to think as entrepreneurs today. And you're leaving a nice, sure salary, you're going into a new enterprise. So that normal profit is the minimum return you're looking for before you say, hey, I made a stupid decision here, okay? So it's the minimum return a business owner requires to stay in operation. Covers all explicit out-of-cost and implicit opportunity costs, resulting in what we'll call zero economic profit. Now, economic profit, okay, I'm going to come back to this slide in a minute, but economic profit is what's left over from revenue, as you see on the top line here, after you pay for all of your explicit and implicit costs. So I guess the second line here is economic profit. It takes the first line, which is revenue minus explicit costs, and then you subtract implicit costs from that. So what's left over is economic profit, okay? And part of that implicit cost will involve the salary you gave up when you quit your job at the post office, okay? That's what I'm saying here. It might be something you would overlook. So if you think about it, say, if we made this real simple for a moment, no other implicit cost. But if you go into business, say, and you quit your $50,000 a year job at the post office, and then an economist asks you, what's your profit? They're looking for economic profit. Then they're looking for anything that might be left over out of revenue once you pay for both your explicit and implicit costs, including that salary you had at the post office. So if you say, well, my economic profit's $10, okay? That means you're doing $10 better in this new enterprise than you were before when everything shakes out. And that's a good thing. Now, most of us are not impressed when we hear that someone had a $10 profit. You go, what? You can't live on that. But an economist, the way they look at profit, and this is the point here, an economist, when they look at profit, if the profit's $10, they're saying you're doing $10 better in this new enterprise, once you account for everything, than you were before. Okay? And so a positive economic profit's a good thing. And if you enjoy a positive economic profit, then expect others like you to enter the industry if they can. Okay? Does that make sense? I mean, you're friends at the post office. They're going to say, hey, you're doing a little bit better, aren't you? May not be much. They're going to say, you're doing a little bit better. So they also will move into the industry. And so we're going to see later, when we talk about market structures, we're going to see that a positive economic profit is the lure for capital and other individuals to enter an industry, as long as there's a positive economic profit. And so typically speaking, at least in a competitive market structure, economic profit however small, if it's positive, gets kind of competed away. It gets whittled down to zero. So you quit your job at the post office again, you start landscaping, you have a $10 economic profit. That means you're doing a little bit better. Your friends are going to do the same from the post office. Guess what? Your profit's going to go down because you got more competition. So that's kind of the idea there. We're going to revisit, and we're going to do some calculation. We've done a little of this before, but in the way of computing economic profit and accounting profit. But it shakes out this way, okay? You see total revenue on the right. If you take total revenue and you subtract your explicit cost, we call those accounting costs. These are things that you write a check for, say, or you use your credit card for. They involve monetary outlays, explicit cost, okay? These are things that we certainly appreciate. Just think again of writing a check for these things. Anything you might write a check for would be an explicit cost. So once you subtract that from total revenue, then on the right there you have what's called accounting profit, okay? Accounting profit. Now, economic profit, you see at the top on the left, is always smaller than accounting profit. Because what we do is we take economic profit, and you'll notice here on the left, we've got explicit cost in the dark green. We take that out of revenue as well, but also take out the implicit cost, including that normal profit, which maybe largely is that salary you were earning in your next best alternative. And what's left then is economic profit. Economic profit can be very small, but if it exists at all, it's a good thing, okay? It's a good thing. So when we talk, though, this is where we're going. When we talk about profit in this class, when we talk about cost in this class, we're thinking as economists. So it'll be economic profit, and then as far as cost, that'll include both explicit and implicit cost, okay? So we'll be coming back to that, and we'll calculate some of that. I intend in this chapter here to do a little session on working problems from the back of the chapter into the chapter. So we'll be doing some computation. I'll just say here, they work a very good example for you on page 174 of your text. I might just mention that a second. Radar, can we go to the doc cam just for just a second, then we'll come back to this. Okay, so, whoops. Okay, so there's a discussion on page 174 about computing, first off, accounting profit. You'll see this here. Accounting profit is our first cut at profit. Notice here you got total sales revenue. And this is a shirt maker, you know. Maybe they do screen printing or something. They got cost of t-shirts. I did that years ago in my youth. Print shirts, sell them. Or tried to anyway, I'll put it that way. So you got the cost of the t-shirts. Okay, you got clerk salary, that's somebody who works for you. You got utilities. I mean, those are things you pay for, okay? And then you got accounting profit here, okay? Now, so you typically would pay your taxes on that and so forth. But there's some adjustments to that we make. Certainly your tax liability involves more than that because you have implicit costs that the IRS will let you recognize. But that's the first cut at profit. So on a financial statement, let me just say on financial statements, this is the number you'll see as the profit for a company at the end of the year, okay? Is accounting profit. That's what gets reported to shareholders and so forth. But if you take accounting profit now and you start to subtract all these implicit costs, okay, you're using a room in your house, you could, I'm sorry, I guess that's lying too. You're using a room in your house, you could rent out for the year, there's $5,000 you're giving up. Foregone interest, okay? You're using some money in your business. You need some liquidity or short-term capital. So you need some cash in the cash store or what have you. Instead of investing that and earning a little interest, you're giving that up just to have some liquidity. So that's a cost, okay? Foregone wages, okay? Okay, here you go, foregone wages. This is your wages at the post office, say. You gave that job up that was paying $22,000 a year instead of $50,000. Okay, that's a real cost. That's a cost we tend to overlook in accounting. And then there's this foregone entrepreneurial income. In this case, This is the additional profit that you might earn if you were employing your entrepreneurial talents in some other way. So here, this normal profit, in this particular example they look at here in your text, is $5,000. So all of these are implicit cost. You subtract that from accounting profit and you get economic profit. So we will come back to this. We'll do some computation on this, but I want to set the stage here today about what costs are and what revenue are. Okay, so again, if we go back to the slides here, you'll see that economic profit is always smaller than accounting profit, always smaller. Okay, so what we're going to do today is we're going to look at decisions that managers make in the short run versus the long run. Today's focus will be on the short run. Okay, and the idea here, again, you think about the kind of decisions managers have to make in the short run. A lot of times it's how many workers should I hire? What should our output be? Let's just think of a simple manufacturing situation where you're making chairs, okay? Making chairs. So how many workers should I employ this week or this month to make chairs? How many workers, not only how many workers, but how much material should we purchase? And these would all be variable inputs. And then, what output level will maximize profit? In the short run, though, again, let's think about a manufacturing situation for a moment. In the short run, in economics, we define the short run this way. There's always some fixed input. Okay, you see this fixed plant size. I alluded to this earlier in the course. Maybe I should go back to this just a second. Well, I will here in a minute. I know where we're headed, but the idea here is that if you think of a small manufacturer, typically it takes quite a while for you to enlarge everything if that's what you want to do. If business is really good, you say, I want more workers, I want to produce more output. And by the way, I need more floor space and more machinery. Okay? Now, you can adjust your work level, perhaps even on a daily basis. In this country, it's not real easy to fire people. Okay? You got to write up a letter and so forth and what have you. But for the moment, let's imagine that maybe on a daily or weekly basis, at any rate, we can adjust the number of workers in our plant. Okay? But it's going to take you a lot longer to double the size of the floor space in your plant. So there's a fixed input here. The short run is defined in economics as that length of time during which you have a fixed input. Okay? There's always a fixed input. In the long run, all inputs are variable. Firms can adjust their plant size as well as enter and exit the industry. So our little factory, it makes chairs, you got all this equipment, you got saws, and you got lathes and all that. You can hire and fire workers, perhaps, on a daily basis. It takes quite a while, though, to double that plant size. Okay, so there you're looking at a long-run decision. Now, in the long run, all inputs are variable. So capital, all your capital is variable in the long run. Not just labor like in the short run and materials in the short run, but also capital. You can go out and raise the financial capital and then buy the machinery, which is your physical capital, to produce whatever good it is that you're making. That's the long run. So in the long run, all inputs are variable and firms can adjust their plant size. Other firms can enter. The firms that you're competing with can exit if they want to and so forth. Those are long run decisions. Very critical here. The short run is not differentiated from the long run by some arbitrary length of time, like 6 months, okay, or a year, or even 2 years, okay. It just depends on the industry, okay. How long does it take really for you to double a plant size would depend, say, on the industry. It takes a lot longer to double the size of a coal-burning electric generating plant than it does for a little plant that makes T-shirts. Okay, so you see how the long run and short run could be defined differently. Okay, so here's some relationships that we're going to encounter in the short run. So our focus here today, at least initially, is on the short run. There's something called the total product. The total product is just all the stuff that you produce. Okay, so again, chairs. How many chairs do you produce in a period of time? Okay? The marginal product is the change, though, in total product divided by the change in the labor input. Now, we're going to assume here this is a labor-intensive situation, a factory, where we determine our output by the number of workers we hire. So if we want more output, we hire more workers. This is the primary variable input to production is labor. Okay? That's what we're going to start with here today. There's some materials as well. I mean, you're making chairs, you need lumber. That's a variable input. If you want to double that number of chairs you make in a month, you need twice as much lumber, wood, and so forth. Yeah, but today we're kind of rivet. We got to start somewhere, so we're going to rivet on thinking in terms of labor as being our variable input. So the average product, okay, and marginal product are things that are going to be expressed in terms of units of labor. Marginal product is the change in total product divided by the change in labor input. Average product is the total product divided by units of labor. Okay, so I hope this makes sense. We're going to be doing some calculations with this in a minute. This marginal product, we had an expression like it when we were talking about utility, when we were computing marginal utility. It's kind of the same thing here. Okay, I know I'm jumping back and forth, Radar. Can we go to the doc cam here just a second? Because I want to put this up where it makes sense to us. Okay, so my hand's jumping around just a bit. Total product, I'm sorry, that's Teddy Roosevelt, TR. Total product. Let me get a pen here that works a little better. Sorry about this class. Here it is. I got my wrong pen. Okay, so total. Here we go. Total product. I did it again. I'm sorry. Dr. J is not with it today. Total product. Okay. I'm sorry. I'll try it again. Did I tell you I was up all night? That's why I'm not thinking clearly today. Okay, let me try another. Okay, here we go. Total product. I don't know, muscle memory there. Okay, so this stands for total product. This is your output. And this could be in a period of time, something like that, maybe a month or a day. All right, so what we were just now looking at here with marginal product we said is the change in total product divided by the change in labor. Okay? So we're going to use L here for labor. So it's change in total product divided by change in labor. Average product, okay, AP, is the total product divided by the units of labor that you employ to make the total product. So if we're going to look at an example here in a minute where this hopefully will make sense to us, but average anything is a total divided by the number of units that produces that total. So if we had a little factory going here today, and I know a number of us are out today. In fact, one in particular I knew was going to be out, but say there's 3, 4, 5, 6, say there's 10 of us, okay? There's 10 of us in this room. If you take the total number of chairs that we could produce in a day, that would be total product. If you divide it by 10, that'd be the number of worker days, okay? Number of labor days, then you'd have average product. That's all we're saying here. Okay, it's that simple. Okay, so okay, let's go back to the PowerPoint then. Okay, so I just wanted to make that clear to us here. Okay, so that brings up the law of diminishing returns. I alluded to this last time as a look ahead. This is like our third law, if you will, in this course. We had the law of increasing opportunity cost we used when we constructed a production possibilities frontier or a supply curve. We talked that, we're going to revisit that. That's a short run relationship. We also had the law of diminishing marginal utility. That was in chapter 7. Here we have a law of diminishing returns. The law of diminishing returns. This applies when resources we're going to assume, are of equal quality. All right, so we're going to assume that we're talking about labor here for a minute. One worker is as good as another. The output you can produce in the way of chairs would be the same as me. Okay, So resources are of equal quality. Technology is fixed. Okay, so the idea here is that you may have several firms in the same industry. They're all utilizing the same technology, okay? No one has an advantage or what have you. Or the technology is fixed through time, primarily is what we're looking at here. So if we're looking at the average product of labor over the course of a month, then we're going to assume that the level of technology employed in that calculation is fixed over time. Variable resources are added to fixed resources. Here's the thing, okay? This law of diminishing returns applies in the short run, but not in the long run. Okay, the law of diminishing marginal returns to labor. Okay, at some point the marginal product will fall. And the rationale here is crowding out. Okay, all right, so let me draw a little picture here again. I know I'm jumping back. I had this weeks ago, radar if we can. Here's a little factory that makes ball bats. I recall we use ball bats. Your book uses a McDonald's station where you got a fryer and you got a serving station and so forth. But it's ball bats are made out of hickory. And so you got these several things. You might have a chop saw here, okay, you might have a lathe over here. Just to make this real to us, so you might have a lathe here, and then you might have a finisher here where you apply the lacquer or whatever. And then you have a shipping station here where you box these bats up and you ship them out. Can you imagine 4 stations on a factory floor like this? Okay, now I want us to think through this, and then we're going to look at the example in your text with numbers. You're going to have workers here, and the more workers you have, the more output, at least for a while. You can have 1 worker, or you could have 2 workers, and so forth. Okay? So, of course, if you keep increasing output and you try to put 1 million workers in there, there's not enough room for them to move around. So the point is there's a limit to what we're going to talk about here. If there's so many workers here that you have complete crowding out and there is no room to move, then your output's going to be 0. But I submit to you that if you initially hire just 1 worker, they'll have an output level. Let's just make some numbers up because this is just a principle I mean to make here. They might be able to produce 100 bats in a day, bats per day. That would be their average output, okay? Now you have 1 worker, they're running around between 4 stations. So there's time between tasks and so forth, okay? And then, you know, this person, like anything else, sometimes it takes a while to get going. Okay, to me, Tuesday's like Monday because this is my first class. It's like, whoa, it's a long weekend, so it takes a little while even to get smooth at teaching. But whatever it is, usually, because there's time between tasks, the first units you produce aren't produced as quickly as the subsequent units. You get a little more proficient at your job. This person really never gets a chance in a work day to get warmed up to any one particular task because they're moving from here, here, here. Okay, but say they make 100 bats. So if you hire 2 people, I submit to you they'll produce more than double what 1 will. Why do you think? I'm going to just put a number here, 300 bats in a day. Okay? There's a very good reason or reasons why if you double initially the level of input, this is labor input, you'll more than double the level of output. You see, this is more than twice that. Why? Well, if you got 2 workers, you can keep 1 over here and you keep 1 over here. So there's some degree of specialization that's beginning to occur here. And because of specialization, there's a little less time between tasks. There's a little less time required to get warmed up to any particular job and so forth. You see here, it's because of specialization. Specialization. Because of specialization, you can experience what is called increasing returns to labor. Okay? That is, if you double the labor, you'll more than double the output. I hope that makes sense. And see if I will double this, if I go from 2 to 4, okay? Being a little facetious here, but so now I got 4 workers. It seems reasonable to me to assume that the output here will be more than double the output here. In other words, this might be 800 bats. in a day. Now why is that? It's because you can put one worker on each machine. Okay, one worker on each machine. Again, we double the input, we more than double the output. If it's true that when you double the input, you more than double the output, if that's true, you're experiencing what's called increasing returns. Increasing returns, or returns to labor, to that variable input. Okay? Now, I might add a fifth worker and might really get going, because with a fifth worker, I got an extra person here who can go around and spell people off when they need a break and so forth. But at some point, if I keep stacking workers in here to increase output, what's going to happen? You're going to have workers standing around with their hands in their pocket, right? Because they're waiting in line to use the chop saw or the lathe or what have you. Oh, what's happening there? Okay, this is the law of diminishing returns. Now this is the one we're talking about, diminishing returns. This is the one that is a short-run phenomena. Diminishing returns is in the short run. Now why is that? It's because in the short run you have a fixed amount of floor space. Okay? By definition, the short run says you have some fixed input. Now it's not labor here, but it is floor space. And since you have some fixed input, that means if you continue to apply increasing amounts of the variable input, then they have to share decreasing amounts of the fixed input. So you're going to have several workers waiting on, well, the chop saw or what have you. And so you're no longer going to be doubling your output as you double your input. Or really, we could look at this more finely here. If it were the case when you double your input, you double the output, it would also be true that if you increase your input by 20%, you would increase your output by 20%. Okay? Doubling just means you increase by 100%. Okay? So whatever it is, and if we had a fifth worker here, we would be increasing our input by 25%, going from 4 to 5 workers. And you might increase your output by 25%. That means this would go to 1,000. But at some point, okay, because you're in the short run, when you add a certain percent increase to your variable input, you'll no longer be able to sustain or create an equivalent percent increase in output. This is diminishing returns, which is a short-run phenomenon. In the long run, you can go back and double your floor space and double the number of machines. Okay? And so you're not going to have this crowding out effect that we notice by definition has to occur in the short run, because the short run is the length of time under which you have some fixed input to production. Now, does that make sense, class? See what I'm saying there? Okay, so in the short run, there's something you can't expand with your labor. And so you might initially have increasing, you might, and I'll say might, you might initially have, in most cases you will have increasing returns to labor. But, I mean, maybe there's not much time between tasks and so forth. But you will have, necessarily will have, diminishing returns to labor in the short run because you have fixed floor space. So I hope you can read my chicken scratch there, okay? So what we're going to do, we're going to go back to the slides here. We're going to look at an example, okay? So this is the example they give you in your text. Here's units of the variable resource on the left. So this is labor. So you got, in one day, you could have 0 workers. Now, 0 workers not going to produce much, right? 0 total product. 1 worker will produce 10. 2 workers will produce 25. Now, notice when you go from 1 to 2, you double the input. And you more than doubled the output, right? More than doubled. In fact, if we skip over 3 for a minute, 3 workers. If we go from 2 workers to 4 workers, can you see that? I guess my little arrow thing doesn't show on the screen. I don't think. Maybe it does over here. Here it is. Okay? I don't know if you can see it or not. But if you go from 2 to 4 workers, you'll more than double the output. Again, you'll go from 25 to 60. So somewhere up to this level here, you're experiencing what are called increasing marginal returns, or just increasing returns to labor. All right? So that is to say, the percent increase in total product will exceed the percent increase in the variable input labor. Okay? So you go from 1 to 2, that's a doubling. If you go from 2 to 3, that's an increase of what? 50%, right? When you go from 2 to 3, you increase 50%. Notice we increased output by more than 50%, going from 25 to 45 chairs in a day. See? Okay, so because of specialization, you've initially experienced increasing marginal returns. But notice what happens eventually. You'll experience diminishing marginal returns. So for instance, when we go from 3 to 4, we increase our output by 15 units. But when we go from 4 workers to 5 workers, we're increasing our output only by 10 units. Why? Because you're getting some crowding out. You got some people waiting to use the chop saw. Okay? Hope that makes sense. Okay? Now at some point, you hit the wall here. With 6 workers, 6 workers will produce the most output you can produce in that little factory in a day, 75 ball bats. It's just use ball bats there in a day, okay? There's my little thing there. If you start packing them in beyond at least the 7th worker, then there's real crowding out occurring, okay? You have, well, it's getting so crowded in there, people can't move as well as they could before. So output begins to go down. So here you're experiencing negative marginal returns. Hope that makes sense. So you have this thing, average product here on the right, that you notice the values here. It goes up and goes down. Average product is total product divided by labor. So 10 divided by 1 is 10, okay? 25 ball bats for 2 workers is 12.5 ball bats per worker, okay? 45 ball bats for 3 workers, come over here, you see 15, because 45 divided by 3 is 15. So I want you first off to see a couple things. First off, how do you calculate marginal product? It's the change in total product, delta TP over delta L, that's what they're saying here. And then how do you compute average product? Well, that's just the total divided by the number of units of labor. But back on marginal product, notice it initially increases. That's fairly typical, but this is always the case. You will experience diminishing marginal returns. So a total product curve looks like this. Total product curve looks like this. You'll notice initially with the first worker and then the second worker, output's increasing at an increasing rate. But when we went from the second to the third worker, the rate of increase in the input, that is labor, pretty much matched the amount of the percent increase in in output. That is, we got about, if we went from 2 to 3, let me just go back there, 2 to 3 workers. 2 to 3 workers, that was a 50% increase in labor. You're going from 25 to 45 output. So that's almost, okay, that's on the range of a 50% increase in total output. Okay, not exactly the same. Let me go back to where we were. There it is, our total product curve. But the point here is, at some point, if you come back over here, at some point, I lose my arrow here. Initially, you're increasing output at an increasing rate as you hire more workers, but beyond this point, they call that an inflection point, you're still increasing output, but at a decreasing rate until you reach a total of 75 as your maximum output. That's when you have 6.5 workers. Okay, so how do you have half a worker? Maybe someone works half a day or something, or they just kind of work 30 minutes every hour or something. Beyond that, total product falls off. So this is called a total product curve. Total product curve. All right, so we're going to see this graph here, how it relates to this graph. What we see in this graph is with the red curve, marginal product goes up and then it goes down. It's U-shaped, but upside down U, and so is the average product. Okay. All right, let's focus on the red curve for a moment. you experience increasing marginal returns when the marginal product is rising. You're experiencing diminishing marginal returns when the red curve or marginal product curve is decreasing. So I want to draw you a picture on this, okay? And we'll come back and see where this picture makes sense. Let's see, I have a, here we go, I think it's here. Okay, I want to draw on this picture that we just looked at. Let's go back to the doc cam if we can. Okay, where did I do this? Total product. I don't see it. Just now had it. Just now had something and I misplaced it. But anyway, okay. All right, a couple things I want to mention here. Average, recall, is total divided by the number of units of labor. So suppose we want to find the average product for 2 workers. So I'm going to write on this. Here you go. Hang on, class. Okay, so let's find some things. We're talking about marginal product and average product. So let's find average product of 2 workers. Now I'm going to use I'm just going to use this notation here. Average product of 2 workers. Now this is the total product divided by the number of workers. Okay, so you take the total output and divide by the number of laborers, in this case is 2, and that gives you an average. Now, from this curve, we can find out what that is. 2 workers will produce 25 ball bats. So the numerator in this expression here is 25. The denominator is 2. So it's 25 units of output per 2 workers, or 12.5 units per worker. Per means divide, right? So per worker. Now we saw that on that chart. That was in the right-hand column. I don't have it right here with me. But this was the average product of 2 workers. And you say, well, big deal. Okay, now I'm going to show you where that is on this graph because this is very important. If I draw what's called a secant line from the origin to the point above 2 workers, then the slope of this secant line is the rise over the run. Do you see that the slope of that secant line, secant means to cut, by the way, so it's a curve, it's a line like this that cuts the curve in 2 points. Do you see that the slope of that secant line is 12.5 units per worker? Measure on the vertical divided by the measure on the horizontal. The rise is 25 and the run is 2. So what I'm saying here is that the slope of the secant line gives us the average product of 2 workers. Okay? What's the average product of 4 workers? I'd do the same thing. I'd connect this point up here above 4 workers and I would do this. And the slope of that is the average product of 4 workers. Do you see first off that the average product is the slope of these lines that I could draw from the origin to the point above the level of variable input we're employing, whether it be 2 workers or 4 workers or 6 workers or whatever, or 5 workers. So for 6 workers, what's the output for 6 workers? It's 75 ball bats. Divide that by 6, and that's the average product. So I'm going to just extend that here with this secant line. Say, well, big deal. Okay, first thing I want you to see is this. The average product, if you think of it in terms of being the slope of a secant line, initially, let's see if I got something that will work a little better. Initially goes up, and then it comes back down. Does that make sense? That secant line goes up to a certain point. In fact, the maximum looks like it occurs right about here, around 3 workers, but it goes up, and then those slopes go back down. So if you're thinking about the average product of labor is something that increases and goes down. So we had a graph here just a moment ago. I don't want to go back to the PowerPoint, but it's in black and white here. We had this thing we were looking at in color just a moment ago. First thing I want you to see is average product in terms of quantity of labor employed goes up and goes down. It's the first thing I want you to see. Okay. The second thing is the marginal product. Okay, is there any questions on that? See what average product is graphically. Marginal product. And this is where I'm looking for my other sheet of paper I just had. It's kind of funny. I just laid it down and it vanished on me. So y'all be patient with me here because I have another sheet of paper just like that. Hang on, hold the phone because I had that. That's wild. I just had it. Must be over here. It's not. Don't know what happened. So what I'm going to do, I'm going to just trace that total product curve out again here. I'm just going to lay this on top so we can see it. Here it is. This is aggravating. All right. And I didn't put it here, apparently. So here's our total. Well, class, bear with me because I have another one. No. Where is it? That is wild. Well, I tell you what. Okay, I have this here, so let's look at this one. Okay, I'll just zoom in on it. Same curve, it's total product. Again, what we just noted with average product, this slope of a secant line. So it goes up and then goes back down. So average product curve goes up and then goes down. Now let's talk about marginal product just a second. What's marginal product? Marginal deals with the additional product. Remember, marginal product is the change in the total product divided by the change in labor. Okay? Change in the total product. Now, remember we had it kind of formula like this before when we talked about marginal utility is change in total utility over the change in labor. That's a delta there. Okay? This is marginal product. What do I mean by that? Okay, suppose, for instance, we want to go from 1 worker to 2 workers and find the marginal product. That's different than the average product of 2 workers. The marginal product of 2 workers, I'm going to designate this way. Marginal product of the second worker is our notation here. It's the AP sub 2, average product of 2 workers. This is the marginal product of the second worker. Is the additional product for that worker. So it's the slope of this line here. Okay? The slope of that line there, it's a different kind of secant line, isn't it? It's a line that doesn't start at the origin. It starts at 1 and goes to 2. And the slope of that line, it's kind of the hypotenuse of this right triangle. The slope of that line is the marginal product of the second worker. It looks to be, just looking at this graph, something on the order of 20 units. We'll go back and look at it exactly in a minute. For the third worker, it would be the slope of this line. It's a different kind of secant line. Okay? And so forth. So, for the fourth worker, it would be the slope of this line. Okay, I've just completed out a right triangle. But at any rate, what is the slope? It's the change here. It looks to be, I don't know, it looks to be like about 15 units, maybe from here to here, divided by 1 unit. So the marginal product of the second worker looked like it was about 20, I'm just kind of guesstimating, units of output for an additional worker. per laborer or daily worker. Okay, but the marginal product, and I just said 20 because we're eyeballing in here. The marginal product of the fourth worker, MP4, looks to be, something on the order of 10. Okay, units per labor day or labor hour, but the quantity of labor we're measuring worker days. Okay, so here's one thing I want you to see, is that the marginal product is a slope of a different kind of line. It's a slope of this line that joins two adjacent points. And what I'd like for you to see is if we slap those things on this thing here, then these slopes, these that connect adjacent points, we could do that as well, will look like, it's kind of hard to see. I don't know why I don't have it here. But are these secant lines here? Now, okay, so let's just think about this a second. Let's just zero in on this. Sorry about this. The marginal product, also like the average product, increases. Here we go. These slopes increase. But then what? They decrease. Does that make sense? You see that? So the marginal product also increases and decreases. Goes up and it goes down. All right? Now let's look at this slide. Radar, can we go to this slide I had on PowerPoint? Okay. All right. So initially, both these curves, I'll just say, are U-shaped. They're down. They're upside down U's. They go up initially for increasing levels of labor, and then they go down. Both are U-shaped. One thing I want you to see is this: whenever the marginal curve is above the average product, whenever the marginal product of labor is bigger than the average product of labor, the average product is increasing. Whenever the marginal is below the average is decreasing. Okay? Now, you say, what? Okay, I'm going to give you a simple example, then we're going to see it on the graph. Because this is kind of, it's conceptual, but it's important for what we're going to be doing. A marginal value, whatever it is, whether it's cost or whatever it is, always pulls the average in its direction. Remember, the marginal applies to the next unit. So let's just give an example here. Suppose we've had 10 quizzes in this class, and you have an average of 89. Okay? An average of 89. You want an A. All right? So on the next quiz, we've had 10, so the next one would be the marginal quiz. You're going to have on that quiz, to pull the average up, you're going to have something greater than what? 89. Okay? 89 on the 11th quiz will pull the average of all of your quizzes up. And 88 on all of your quizzes, on the 11th quiz, would pull the average of all of your quizzes down. The marginal pulls the average in its direction. Another example. Of course, I'm the outlier here, but suppose the average age, because of me, the average age in this room is 30. My mother walks into this room. What happens to the average? Does it go up or down? Goes up. Obviously, we know this. So I'm telling you something you already know, but I'm going to show you where on the graph it's obvious too. Okay? The marginal is the next one to come into the room. If that one's value is greater than the average, that is the age, so her age, she's 85 years old, so she comes in here, she's 85, she pulls the average up. If my daughter walks through that door, she's going to pull the average down. We all know that. So whether you're talking about cost, whether you're talking about age, whatever the metric is, the marginal pulls the average in its direction. Now, so when I say this right here, as we add workers from 0, 1, 2, and so forth, notice that when the marginal is above the average, it's pulling the average up. When the marginal is below the average, it's pulling the average down. So remember what the marginal cost is? It's the slope of the little segment, the little secant line, if you will, between adjacent values of L. When that when that value is greater than the average, it's pulling the average up. When it's less than the average, it's pulling the average down. So first off, that will imply, and we will spend a little more time on this, but that will imply, first off, that the marginal will intersect the average in its maximum point. Okay? Because when the marginal is above the average, it's pulling up. When the marginal is below the average, it's pulling it down. We're going to see this over and over again. I'll just make that observation now. But also, if we go back to our cost curve, let's look at this one. Let's go back to the document camera again. And I know I'm not doing the smoothest job in the world presenting this today, but hopefully you get the idea. That's all that really matters. Let's talk here again about the average product of two workers and the marginal product of the second worker. That's what I got there, right? This is AP of two workers, and that slope there is the marginal product of the second worker. Notice here that the slope of the secant line joining this point from the origin is less than the slope of the secant line here that measures marginal product. Marginal product here is greater than the average product. Marginal product, that line is steeper, has a bigger slope. So when we go from 1 to 2 or what have you, the average is increasing. What am I saying? Is that in this range, these secant lines that join the origin are increasing. Okay? These secant lines from the origin are increasing in slope. Why? Because the marginal cost of each unit in this level here, up to here really, up to about here, is greater than the average. So because this small segment has a steeper slope than this larger segment, the larger segments are rotating up. Average is increasing. It looks like average will be a maximum right about here. Okay? Does that make sense, class? Now, what about over here? What if we go to the sixth worker? The marginal product of the sixth worker is this. That's the marginal product, MP, of the sixth worker. The average product of 6 workers is this. This is the average product of 6 workers. Sorry. Now notice here, the average is greater than the marginal, right? The average is greater than the marginal. In fact, that's going to be the case once you pass some point right in here. Okay? When the average is greater than the marginal, that is less than the average, it's pulling the average down. Okay? So when the small segment is steeper than the average, it's pulling the average up. When the small segment, which represents the marginal cost of an additional unit, whatever the unit is, when that's less than the average, it's pulling the average down. Make sense? So what I'm showing you here is that average marginal rule, again, that we just noted. The marginal always pulls the average in its direction. The marginal always pulls the average in its direction. Over here, the marginal is pulling the average down because the marginal, well, that segment there has a small slope. Over here, the marginal is pulling the average up because the marginal cost curves have a big slope. Okay, so let's go back to this a second. Back to this slide. You might think about that. Can we go to the slide? Okay. All right, so again, both these things go up and they go down. But the red curve, marginal. For the first worker, it's bigger than the average for the first worker. It's pulling that average up. For two workers, the marginal cost or marginal product of the second worker is greater than the average product of two workers. So the average product's pulling up. When you get over here, we went to that sixth worker, the marginal product of the six workers. Let's say it's telling you that the curve is kind of almost level at that point. Okay, because this is close to zero. But the marginal product of the sixth worker is less than the average product of six workers. So the average is being pulled down. That average marginal rule, that's what we were using here just a moment ago. That's basically saying that the marginal always pulls the average in its direction. Doesn't matter what. If we're talking about how much money's in your wallet, so the old question, what's in your wallet? So if we could read everybody's money here and say, on average, you know, we got $20 in our wallet. And then my son, who's megabucks, walks in here. He's got a lot more money than I'll ever have. He's going to pull the average up, okay? And so forth. It doesn't matter. We're going to talk about product in this class, and we're going to talk about cost. Here we're talking about product, okay? Marginal product and average product. The marginal product will pull the average product in its direction. Here are those two curves together. And what I'd like for you to do is kind of think of those two together, okay? And you'll see here that basically again, in this range here, you got increasing returns to labor. That is an additional labor. Gives you a proportionately larger increase in additional output or product. So you're increasing at an increasing rate. Another term for that is this curve, the total product curve, holds water. Okay? Over here it begins to spill water. If you connect 2 points, it's on the beneath the curve. When you spill water, the marginal product's going down. Those small secant lines are rotating down, and as it's doing that, it's pulling the average down, okay? So the marginal, when it's below the average, pulls the average down. Okay, all right. Now here's where I got just a few minutes, look like 7 minutes here, so I want to make sure we get to a particular chart. We're going to come back to that concept. This is something, okay. I've done a better job usually in presenting this, and I've made some videos, and when I changed schools and so forth, that I kind of lost some of that. Else I'd put a nice video up for you here, but I think you got the idea. If you'll consider that total product curve at the top and look at how that you produce these two this average and marginal product curve on the bottom, this should begin to make sense to you. We're going to come back to this relationship here in a minute. All right? We're going to talk about production cost here in next, going forward. I want to see, okay. I guess before we go to cost, here we're looking at product. I just want us to make sure we understand that as one of these curves goes, as the total product curve here increases at an increasing rate, then you have increasing marginal returns. So the marginal product curve is increasing. The slope of those small tangent line, or secant lines are increasing. And then beyond some point, it looks to me like it would be about, you see where those two curves intersect? If I move up there, it looks like it's about 3.5. If I'm at 3.5, that looks to be, if I connected that point with the origin, if I connect this point above 3.5 with the origin, that looks to me like that would produce the secant line to the origin of greatest slope. Beyond that, those secant lines begin to rotate back down. And so, but at any rate, you're initially experiencing increasing marginal returns and then diminishing marginal returns. Notice here, the total product is maximum when the marginal product is zero. Does that make sense? Okay, if we went back to our total product curve here and we said, well, what's the marginal product of the 7th worker? Do you see if I connect these 2 points here, I get a line that has a 0 slope? Y'all see that? Can y'all see my little dot up there? The line would have a 0 slope. So that means the line, the total product here is neither increasing nor decreasing anymore. Okay, it's maxed out. This is another relationship I want you to see. When the total is maxed out, the marginal is 0. Okay? And that's a very important relationship we use in microeconomics a lot. We're going to want to maximize profit later. This is product. TP stands for total product. But we're going to want to maximize profit. And the way we'll do that is to find out where the marginal profit's equal to 0. In general, if you want to maximize some quantity, you look for where the marginal is equal to 0. Okay. All right. Okay, so here's where we're going to go from this, okay? We're going to go from product to cost. And so I have a slide here where we're talking about fixed cost and variable cost and so forth. But in your text, I think this is a good place to stop because I want to draw the line here. Before we go into cost, I want us to have some intuition here. Hopefully we've built some intuition here about the relationship between total product, average product, and marginal product. Because we're going to take those concepts and we're going to talk about cost in a minute. And there's a relationship between production cost and the product that we produce. For instance, okay, if you have increasing marginal product, that is, the second worker from the first to the second worker more than doubles your output, guess what? The units of output you produce are coming at a decreasing cost. And increasing marginal product says that the cost of those additional units are coming at a lower value. It's a decreasing marginal cost. Now, we're going to have a cost curve here in a minute that looks like this. Let's go to the slide just a second while we got time here. I want you to read this in your text, and we just don't have time. Here's a blue, see that blue curve there? It's kind of an S-shaped curve. In fact, the green one, let's start with that. It's kind of an S-shaped curve like the total product curve is we just had a moment ago. There's a reason for that, okay? This is where we're going, short-run cost curves. We just don't have time today. But we're going from the total product to the total cost curve. We're going to go from the average product to the average cost curve, and we're going to go from the marginal product to the marginal cost curve. In particular, I want you to see, and I guess our picture went away. If we can pull that up again, we're about done. We can't, it's not working. It's not working. Okay? All right, does the document, well, the document camera doesn't work. Okay, so at any rate, I think that's pretty good for today. Read this, and we'll come back and talk about your cost curves next time, okay?